Welcome everyone to a great event this afternoon. This is an event that is part of a series of events called Questrom Insights. We are all sitting at home and using Zoom and try to basically make sense of the situation we are in. And as an academic institution, we are basically responsible also to provide great content to all of you that help you to think about the current situation from a personal, but also from a more maybe a macroeconomic point of view. So it's a great pleasure to welcome Tobias Levkovich. So Tobias Lefkowitz has actually reached out to us and asked if he could do this event. He is the managing director and chief equity strategist of Citi. He's a member also of Citi's investment strategy committee. So in this role, he basically will sees clients and talks about the direction of the market, about setting the firm's sector allocation, and also he compiles the recommended list, basically of specific investments that he expects to appreciate. So he has a long career at Wall Street, I think 35 years overall. And he started like analyzing engineering, construction, and machinery industries. And his background is as a bachelor in commerce from Concordia University in Montreal. And then he is most importantly alumni of what is now called Questrom, but at the time when he attended, it was the Boston University Graduate School of Management. When did you attend Questrom, Tobias?
1984. I am that old.
1984. So the way we want to structure this event is basically give you some kind of global overview about the market and so on. Tobias has been talking to a lot of clients. We are in a situation where really the world economy is in uncharted waters. So it's a shock to a relatively healthy economy that started. So basically there's almost no unemployment, and within a short period of time, the jobless claims are surging to 5.5 million. There are predictions out there that the unemployment rate in the second and third quarter may go to 15 or 30%. And it's a real time of economic uncertainty because actually really difficult to quantify even some of the risk because it's really difficult to say what exactly is happening. So it's very different than typical situations where maybe there's risk, but if you can quantify it, you can also basically hedge it from a finance point of view. This is much more difficult. And it's basically a situation where for once really consumption or so has almost come to an abrupt stop. And so Tobias, you have been talking to a lot of institutional investors in the last couple of days and provided them with insight. So what did you tell them?
So I'm going to give you kind of the rundown from what I've been talking to over 60 institutions over the last couple of weeks, and one-on-one phone calls, several hundred if we include conference calls. And the one thing I'm going to push back a little bit, the consumption has not come to an absolute halt, certainly not based on the Amazon deliveries at my doorstep. So maybe I'm different than most, but I'm trying to stay as physically distant from people as possible, and as a result, everything's online ordering. So I think that's happening around the country. We've seen, the further, if you want to call it, acceleration of the demise of traditional brick and mortar retail. It's really interesting in terms of the acceleration of that, in terms of this horrible pandemic and this unique and rather remarkable experience that we're all going through in terms of socially distancing, in terms of work from home, remote access, shelter in place kind of things. It's teaching us a few things about how we can live our lives. And I shudder to think of what would happen if this was 25, 30 years ago, and we didn't have the communications abilities that we have today in terms of keeping in touch with the world, your family, even if you can't be directly with them. So this is what we've been telling investors. I'm going to spend the next 4 or 5 minutes kind of just rushing through a bunch of things, not to belabor it, and I'd rather kind of get this out of the way so we give you a setting to think about. In late January, early February, we were warning investors that we were deeply concerned about a number of things. We were concerned about investor sentiment being euphoric. We have this thing that we have our panic euphoria model, 9 different factors in the model. We like to build models between 8 to 10 factors because I still remember sitting in my statistics kind of 101 class in the MBA program, listening to my professor telling me that there was a higher probability of an asteroid hitting Earth than 8 factors all losing their correlation at the exact same moment in time. Personally, I don't really worry about asteroids hitting Earth because I know we'll just send Bruce Willis up and he'll save us. But our panic euphoria model was sitting in euphoria territory, 70% probability of losing money. Last time we saw that was September 2018, right before the market did start to fall apart. We don't use things like the VIX. We think that it's not particularly helpful when everybody's seeing the same data you are. You get no quote unquote edge. Number two thing that we were concerned about was household equity exposure. We get this from the Federal Reserve Board. In the household sector, how much equity and mutual funds do they own as a percent of their financial assets? And it was near 50-year highs. So there was a mythical belief on the street. There was all this money on the sidelines in the retail sector ready to come in. Individual investors were going to chase the market higher. They were long and strong already. And three, earnings estimates for 2020 were showing 9% earnings growth. We thought that was too high. We were thinking more in 4 to 5% range, and that those would have to come down. So we were kind of exposed and vulnerable. We never imagined we would have the pandemic. We didn't predict coronavirus. We didn't predict 35% correction market in about 5 weeks. We did consider vulnerabilities and we were concerned about it, but we were thinking kind of a run-of-the-mill 10, 15% correction. So I can't take too much credit for this. What did we do as the news started coming out in February of bigger problems? Well, first thing we did was we took out $10 a share from our earnings estimates for the S&P 500. So we went from $174 down to $164. And that was basically flat year over year at that point. We weren't going to have any growth in earnings. That $10 reflected the China slowdown. What we anticipated were going to be some supply chain problems in the Western world and commodity price weakening. About 2 weeks later, we had to take another $5 out because of the oil prices plunging as a result of the OPEC agreement not coming to an agreement. So we were down to 159. But we started to warn investors that we thought 130 to 135 was a more recessionary kind of number to think about. Typically in recessions, the average decline is 20 to 25%. It was much, much worse in 2008-09, but that's because banks have to take significant write-offs of their subprime loan books. What we've now done, and this was about a week ago, we took our numbers down to 125. In other words, we took even below the 130-35 range we were giving before. And there were two reasons for it. One was Western Europe, US shutting down, but also we were seeing something kind of really unique and differentiated, which was the credit markets were getting very extended and distended in the sense that credit markets were breaking down. Credit spreads were widening very rapidly. People were selling what they could, not necessarily what they wanted. So it was even hitting what you would call higher quality paper. I was told, and that sometime early last week, Apple was floating commercial paper debt at 2% when we have zero interest rates. So, commercial paper markets won't work properly. If credit becomes more expensive, businesses can't get things done the way they wanted to do, and that would have some earnings ramifications too. The second quarter is going to be an unmitigated disaster. I wish I could say it nicer than that, but I can't. Professor mentioned that we could have 15, 30% unemployment. We don't know the right numbers, but I can tell you what our economists are telling us right now is we're going to see an unemployment set of data coming out on Friday. It's almost going to be meaningless because we expect another 10 million people to lose jobs by the end of April. And if that's the case, the May numbers could get you almost to 10% on the unemployment rate just on that basis alone. The concept that you got to think about here is industrial production is going to plummet as everybody's shutting down. And what is so different, remarkably different about this downturn is historically the U.S. has been buffered by its very large services sector. So you would still go out and get a cup of coffee in the morning. You might go to Dunkin' Donuts or McDonald's instead of Starbucks because it's cheaper, but you'd still do that. You might go on vacation, but you might not be hopping on a plane to Florida or to Hawaii or anything like that. You just may drive to, you guys are in Boston, so you're going to drive to Cape Cod and stay at some bed and breakfast. And you could do something to have a vacation, just a much more inexpensive one. You might go out to dinner with the kids, but you're not going to a nice place. You're going to McDonald's or Burger King. As long as they have the happy meals, they're happy. And if your kids are happy and your wife is happy, then you're happy. So in the sense that you'd still have those options available to you. You'd still go to the gym, go to your yoga classes, Pilates, whatever. Get your hair done, get your nails done, whatever was your fancy, you would still do. You can't do any of those things. You can't even go to the dentist for a checkup. We have taken our strongest suit, if you want to think of it that way, in terms of our economic resilience, and it has become our Achilles heel in a world of work from home, shelter in place, and socially distance yourself. And it is crucially important to do so. For those who haven't done any studies and look at the pandemic, the Spanish flu pandemic of 1918, there were two cities to watch at that. There's not a lot of data, but there's a lot of interesting information. St. Louis and Philadelphia. They were the third and fourth largest populated cities in the United States at the time. St. Louis mayor put in a ban on all interaction. He shut down bars, nightclubs, motion picture theaters, because they didn't have movie theaters back then. They shut down all kinds of interact, churches, synagogues, temples, everything got shut down. Philadelphia did not follow suit. Philadelphia ran its course. Philadelphia had 5 times as many fatalities as St. Louis did. So this idea of, and I'm going to be a little bit of a bummer here and say, hey millennials, because I'm tired of hearing hey boomer. Hey millennials, don't go down to Florida and do spring break and then come home and infect your grandmother and potentially kill her. This is not a kind of a fun moment. We got to deal with it maturely and responsibly. Now in 2021, we do anticipate a significant rebound. We think, again, second quarter this year is just going to be horrible and earnings could drop 60, 70, 80%. But you're going to create a very easy comp for next year. So we're looking at about $150. Big 20% pop. Typically, coming out of a recession in the first year, earnings are up 10 to 15%. We think we got a little bit of more leeway here because of it. But we also think the second half of this year will be a kind of a slower slog. People will come out of this eventually, but with a little bit more trepidation. We also believe that they'd be between 2,100 and 2,700. And we got kind of close to that, and I'm not surprised the market's kind of backing off again because it was way too much too soon. Now, our panic euphoria model, which is our primary sentiment metric, went to panic last Monday. Typically, you get an 18% average median type jump to 18.5% on the average, 18% on the median. But that happens 97% of the time. The problem was that we had 18% rally in 3 days last week. So people went from being kind of concerned and cautious to feeling a little bit more frisky, if you want to call it that. The tone of our client conversations changed. They were, oh my God, should I get a gun to protect my family and me? To, oh, we're 2 weeks away from the peak. Things are going to turn faster. Everybody's too down. The world's going to be a fine place. There was a little bit of FOMO in trying to jump in on that rally. I spoke to a significant portfolio manager at a mutual fund complex yesterday morning, and he's saying, Tobias, you're being too cautious. Everything's turning. All my data's starting to turn. I said, I think we're going to have 3 to 4 weeks of really, really bad data. We got a fiscal stimulus, a big one. We got the monetary stimulus, another big one. The Fed is coming in to try to open up those credit markets I was referring to before and having, some degree of success. But it's going to take time for the checks to get to people, the loans to get to businesses. In the meantime, things are going to get broken. Small businesses are shutting down daily. People are being laid off and worried deeply about how they're going to have to pay for things, including what is likely to be a bunch of rent strikes because people refuse to pay their rent, and landlords are going to probably have to eat it. There are 5 things we need that we said to come back in the market. The first thing is the sentiment factor, which I kind of mentioned already. Second one is valuation. We think valuations have gotten to reasonable levels. We can, I can give you a couple of points on that. One, over the last 60 years, trailing PEs in the market when inflation has been between 0 and 3% has been 18 times. And at that basis, using trailing numbers, we'd be looking in the 2400s right now for the S&P. We also think if you look at the history on forward PEs, the average is 15 times, but during the worst, during recessions, and thinking back in '02 and again in '09, we saw multiples north of 20, 18 times on that 150 for 2021 to get to the 2,700 number. But again, there are other things we use beyond that. I'm just trying to give you a quickie kind of comment. Number three, we need earnings estimates to come down. I will come back to that in just a moment related to something else. And the last two things we're going to need is some confidence that our healthcare system can deal with the inflow of sick and ill patients, and that we make progress towards treatment and vaccines. And two, that the financial help that is coming through checks to individuals, through small business loans and the like, will get there and start to have some positive impact. But we have yet to see that. That's still on the come. But we're going to need those to help us, build confidence that we're going to get through this thing. And we will. It's just going to take time. And we were asked a lot about the duration of this. We think at best you should be thinking 4 or 6 weeks, at worst 4 or 6 months, and it'll probably be somewhere in between. Last thing I'm going to share with you is a survey we did, and results from 125 different institutions, responding to a bunch of questions, starting with this idea of earnings. So bottom-up consensus is the analyst consensus on the street, is 0 to -2%, depending upon which set of data you look at for 2020 earnings. Top down, which is strategists, economists, are down 10%. And we're down 24% to give you a sense of how distant we are from the crowd. The client base, the 125 clients that we surveyed, 60% think earnings will be down 10% or more. 25% think that earnings will be down 5 to 10%. And 10% think that it'll be down less than 5%. And whatever they're smoking, you should buy, because it's really good stuff. If you're in Massachusetts, you can go out and buy those in those stores. To be fair, my wife uses medical marijuana, so I got enough pot in my house as well. Now, the 80% still want to buy equities, which is a little bit disconcerting. The number one favored market is the US. Emerging markets is number 2, Asia Pacific specifically. Favorite sector, not surprisingly, tech. It's a perennial favorite, but healthcare jumped into the number 2 spot. That is a newbie. What's disliked? Energy and financials. Energy, not a big surprise with oil prices where they are. Financials, because there's a lot of fears from the last downturn that the banks are going to be in deep trouble. We think banks are in probably better shape. They've got very high capital ratios. The really bad lending is probably in the private lending world. But to be fair, if you had lent money from a bank to an airline or to a cruise line 3 months ago, you would have thought that was pretty money good as well. So there are going to be some problems in banks too. I'm not trying to sugarcoat that. I work for one of them, so I'm not trying to protect it. It's more, this is the world we're in. 85% want to buy large caps, or think large caps will outperform. I think they're looking at the stability and the better balance sheets. 65% like growth over value, but that's consistent with liking tech and healthcare versus disliking energy and financials. And year-end expectations is the market on a weighted average basis of all of these all these survey responses is 2740 on the S&P, with the bulk of the biggest grouping, if you like, around the 2700, 2800 area, and then kind of a normal curve distribution around it. So I've given you a bunch of stuff of where the markets are, where earnings will be, where we think there's some opportunities. And I do think it's going to be the areas that have been the most beaten up. They're kind of coiled springs that it will bounce when there's kind of an all clear sign. And it's almost a function of what we saw in 2000. Some of those .com, they get repriced to survive, if not necessarily thrive. Same thing happened to the banks in 2009, 2010, and we suspect that this could happen again in with some of the beaten up areas. And we got a little bit of an inkling of this, or some glimpse of this last week on that 18% rally. A stock Boeing jumped 70%. Right, it had been obviously one of the very deeply beaten up companies. So we would see that happen with the cruise lines, some of the airlines, some of the hotel stocks. Things that are really getting hammered typically get some of that better balance on the. With that, let me turn it back to questions, and I know I think Marcel, you're going to be collating them from the students as well.
Yeah, I just have sent a chat message and I will repeat it here. So please submit your questions by chat. They are coming in slowly, and I will basically probably moderate them because we are actually having a big group of participants here, like 130. And so it's difficult to actually have you speak here. So I will probably just moderate that. So the first sort of set of questions I had, you described that this recession and so on is quite different than other things we have seen before. Now, do you think that policymakers or so, they are having the right measures to address this? And are they really seeing the difference and basically will design policies that help to really address the fact that suddenly there's no demand for services or certain things are just not being done? Or is monetary policy exactly the same as before, as in 2008? Do we see the same type of credit crunch there? Or how do you see what kind of policies are really most importantly needed, and how well are the current policies designed?
So there's a lot baked in there, so I'm going to try to separate it a little bit. I think one of the things that we're recognizing, and maybe policymakers do a better job of this in the future, is watching how risky some of the credit is getting. So we were seeing very, very tight credit spreads. There's been just massive flows into bond funds, to loan funds, things like that. And it has created this ability to finance with very little, covenants around it. Even the development of private lending, where I know people who are involved there, and they've borrowed money to borrowers at 14, 15, 16%. They think that's okay. And I'm trying to convince them that 14, 15, 16% is very, very expensive money. And are you really sure the people you're lending that money to can ever pay you back? Now, in the corporate world, you were seeing that in the junk bond market, where it was kind of 4% was quote unquote high yield for most, and then you're paying 8% if you're in the energy sector, and maybe a couple of retailers or telecom companies. So the extent to which credit was freely available and the risks associated with it are just blowing up in your face, because leverage is great when things are going wonderfully, but leverage is a heck of a problem when it cuts the other way. So hopefully they'll put some better constraints on that. I think the focus on trying to get money out to small business is critically important, and I think that response seems very smart. They're doing it using the banks as administrators for it, so they're not showing up at the Fed, knocking on the door, or at the Small Business Administration, because literally they don't have the people to do it. The banks are the best way to reach those small business where they already have relationships with. How should I put it? The parts that I'm a little, concerned about is that there was a little bit of pork thrown in here as well, but we've all read the articles of the Kennedy Center, for example. But that's small potatoes. There were just a lot of other small things they didn't need to do. The help to the states, hugely important in the stimulus bill, because they're going to see revenue drop-offs in terms of taxes, and they're going to see things like sales taxes, really falling. Some states with income taxes falling as well. So that's hugely important, and giving money to hospitals is critical. So I think those responses have been good. The Fed trying to gum up and close up everything that's kind of become stuck is critically important as well. The only, and this may be my libertarian streak coming out, the only thing I worry about is certain moral hazards that were always here to save the day, and that we let people do kind of silly things, and we protect them from paying the price for it. That bothers me a little bit, but you're going to have to get some bad with potentially all the good. Not sure if I answered everything in there.
Yeah. So what kind of recovery do you expect? Sort of like a V-shaped, U-shaped, or W-shaped when you talk to your institutional clients? Or what do they expect? Because that's the question about this side. Are we basically now in a situation where also the virus will come back in cycles, and is that something that actually corporations already anticipate and build into their strategies?
So I think initially people were thinking V-shape, very sharp plunge, and Rebound because this is such a unique and differentiated kind of deal. I think it's starting to shift to more view, and that there, we've been of the view for a while. We were worried about second half sluggishness well before this happened for two reasons. One, the elections, so that businesses may not want to fully commit to plans until they know who wins. This is a pretty polarized country, very deeply split in terms of what they support and what they dislike. And in that sense, what could the policy implications be should either President Trump win re-election or lose it to, most likely at this point, Biden as the candidate, but we'll see. And I think people just don't know. Will taxes go up? What will happen? Our sense is that at some point in time, they're probably going to treat capital gains and dividends as ordinary income as a way to tax the upper end of the income spectrum, because wealth taxes have some real issues on constitutionality. But anybody can have a capital gain. So, that's one of the ways, ultimately, I think we're looking at higher taxes way down the road. And that's one of the easier ways, again, to tap wealthier citizens. There's some negative implications from a investment point of view, but I'm not talking about that.
Yeah. So I have some questions relative also.
One last one was the commercial industrial lending standards from the Federal Reserve Board. We watch very carefully. It looks at banking standards, and those have not gotten easy. So those usually lead economic activity in 9 months. And the third thing right now is, could we get a resurgence of infections when weather cools? The epidemiologists are kind of torn if weather is going to help or not, but could we get a secondary wave of this in the fall? And I think people will want to see that to make sure it doesn't happen before they commit capital.
So I have some questions relative to policy measures here. One from Axel Levy about question whether the US actually has exhausted fiscal and monetary support, or they still have basically dry powder to fire in the current situation, that given where interest rates already were, and we are expecting maybe a negative yield on some bonds and things like that. So is there still something to be done in terms of monetary policy and in terms of fiscal policy, or so are there sort of expectations that taxes will change or tax policy will change, that maybe there's some forgiveness for consumers to pay taxes in the short run, or then a restructuring also of corporate taxes in the medium term related to this to basically get some kind of stimulus? What do you think is going to happen there?
So let's start with the Federal Reserve Board on the monetary side. I think there's some mixed opinions about, can the Fed do more? Yeah, the Fed theoretically could buy a lot of stuff. They could even buy stock too. I mean, you're going to have to get some congressional approval to do that, but I don't think the Fed has exhausted the instruments it has. It is more limited because you have zero interest rates already. I listened, and the only reason I'm going to say this is because I listened to one of the Federal Reserve Board members, Charlie Evans, being interviewed on Bloomberg probably 3-4 months ago, maybe 5 months ago by now, and he was asked about negative interest rates. Would U.S. go down that way? And he says, well, I don't know what the benefit is to go to negative 50 basis points versus zero, right? I'm not sure what that generates. If you go to 500 basis negative, then yeah, you're going to be paying people to borrow big time and take risk because you're paying their interest in a very large way. But he said, that would be in the midst of a depression if you have to think of it in those terms. That's the only way that he would perceive it. So I'm giving you something that Charlie Evans said in the public world, not anything. I do know a couple of things that I can't share with you on this, but I apologize because we have strict rules on things we've learned. On fiscal side, oh gosh, governments have ridiculous amount of flexibility. So governments could take stakes in companies if they had to shore them up. Governments could spend tons of money and burden us with debt in the future, but the alternatives would probably be even worse. There is some concern, and we were reading about this in Italy, for example, about southern Italy and social stability, social unrest, as money and attention, is, at least from people who live there, feel it's more focused on northern Italy right now. So could we have those kind of developments? Yeah, and that's why I think government would pull out all stops. On the other side of that taxing power, governments have inordinate taxing power. to kind of make up this stuff. So they can add a quarter of a point to sales taxes in any state. They can increase it on, the corporate tax rate from 21% to 25, 26%, and not everybody's going to reincorporate in Ireland at that, for that. And I suspect that's going to happen ultimately to help pay for some of these things. So I don't think government is out of bullets. In fact, they still have howitzers.
Mm-hmm. Mm-hmm. Now let's talk a little bit about sort of corporate debt and leverage in general. There's a lot of writing out there that there's too much debt out there. And now I think that will hit some companies more than others to basically refinance the debt given the credit spreads we see. And so how do you look at this from a sort of sector allocation perspective in the equity market? So how would you basically structure your portfolio relative to leverage of different industry sectors?
So number one, everybody's already run to the high quality, clean balance sheet names. So it's not like those stocks are cheap. Investors figure that stuff out quickly. So those stable industries that have stable, stable revenues, for example, all those makers of toilet paper that people are hoarding, they're probably fine. You have to think of leverage in kind of three different ways. Okay, there's leverage industries because of their high capital intensity. Mm-hmm. So think about airlines, think about hotels, real estate, think about utilities with big plants. They just don't have an option to put that all in equity. Their ROEs would be horrific if they did that. They have to use leverage. And in times like this, they become, not utilities necessarily, but let's say, real estate, hotels, airlines become very, very shaky. Again, fortunately, this isn't going to last, and they do have alternatives in looking at equity infusions and things like that. It'll dilute shareholders, but they can get through it. Then there are other industries that will use leverage for particular purposes. Strategic acquisitions, things like that. I don't think that's going to end necessarily, but the buyers are going to be a lot more careful of what they pay. And then there's the third group that are essentially companies that are built almost exclusively around leverage. So I'm going to pick on an industry or industry subset that has really done that. The mortgage REITs, for example, they're not traditional real estate investment trusts. They are structures that use the benefits of the real estate investment trust legal framework, but are very, very high leverage to generate that incremental yield for the person to buy it. And I think those kinds of structures are just going to, get obliterated here. And I'm not so sure people are going to be willing to give them the same kind of money anymore. Because remember, if you're already at low interest rates, the only way for it to go is up from here.
Mm-hmm. Mm-hmm. So, but do you think corporations really carefully think about their future capital structure in that?
Oh God, yes. We're seeing companies cut capital, but capital spending, buybacks, dividends, drawing them on their revolvers. They're very worried about cash right now. So it may leave a little bit of a scar after this, that they won't be as aggressive, just as much as every sector after bad experiences kind of act a little different. They learned something from that. That's not every company, but the sectors generally do.
Mm-hmm. Now you mentioned different sectors, and there are a lot of questions about different sectors, in particular healthcare or so. So how do you really look at the healthcare sector in terms of is sort of innovation there really something like telemedicine, or is it basically what is the base? Where do you see why this sector is really a hot sector to invest in right now?
So I think there are three things. I'll get to the telemedicine thing in a moment, but I think the three biggies are they are part of the solution right now, irrespective if you like them or not. Doctors, nurses, etc., drug companies, biotech companies trying to come up with treatments, vaccines. These are our heroes right now. So that gains attention, and their business will be fine in that respect. Two, the populists in Washington can't really beat up on them anymore because of that, even if they wanted to. They just gave them over $100 billion in the stimulus package. So, if you're beating up an industry, you don't generally give them generously lots of money. And number three, Bernie Sanders' numbers have fallen, and people were very concerned about Medicare for all, and the probability of that has diminished very meaningfully. So for the Wall Street community was very concerned about this late last year, and again has been getting more and more comfortable with that.
Mm-hmm. There's a question about energy, whether this is something that is attractive still, or is it something that is more for the long term, or not exactly where the question is coming from, but is it thinking about the context of maybe just sustainability in general, or so did you change your view on energy?
Yeah, we pulled back on energy belatedly because of the OPEC agreement just dying and killing it. So what you're seeing in energy is two things. You're seeing both a demand shock and a supply shock, which is very different than what everybody else is seeing, right? They don't see the supply being as plentiful when Saudi Arabia is triggering a price war. They're apparently trying to hurt Russia. Russia's trying to hurt the U.S. shale world. So the energy industry in the U.S. has been a really horrific steward of capital. For 10 years, they have consistently underperformed on return on equity. And they were getting essentially shut out of the capital markets for the last year or so. And kind of being disciplined, you're going to have to be better, stewards of that capital, or we're not giving you any more. So they were facing that challenge to begin with, and this thing's just blowing up all of the little players. These are the guys that are leveraged, kind of strike it rich by, drilling a hole in the ground. The bigger players will still be around. Some of the smaller players will disappear and go bankrupt. This is a tough place to trade around right now. We're going to be using oil for many, many more years. We're going to all go electrification. We're talking about 2 billion cars on the planet, and 500,000 to 1 million being electric today. Mm-hmm. We're going to be using fossil fuel for a while, so it's not like it's all going. The growth rates are going to diminish clearly as you see other, electrics coming in. I'm personally more pulling for fuel cells, but that's just me. And then the reason I'm not that gung-ho on electric is that what people kind of forget is that 60% of electricity is still generated by coal. So I'm not sure if you're trying to be environmentally conscious, you're not necessarily doing it that way. So, even in China, which has been more aggressive, China does probably 90% of their electricity in coal. I don't know why anybody's cheering that.
Mm-hmm. Mm-hmm. So I have another question here. Is somebody asks, I think Doug Young, what sectors do you think will be the first to rebound?
So we were getting a lot of those questions from clients 2 weeks ago, which also meant that too many people are too busy trying to find places to make money in stocks, and they're not scared enough. Okay? We actually want them to feel a terrible pit in their stomach about ever investing again. That's when when there's real capitulation, not, ooh, what can I buy in the bounce? And I do think there's a potential for value to take leadership from growth. Usually this kind of market turmoil changes leadership. Healthcare could be a winner here, though it's not traditionally value. It is actually a value group today in the way Russell breaks up price to book. But the value stocks could do better because usually in these tumultuous periods, there is a handoff in leadership from one group to the other. So back in 2001, 2002, as we saw the tech bubble burst, value got its kind of legs going, and it ran until 2008. And then the banks blew up on subprime real estate, and value collapsed, and tech took over for the last 12 years. So it is very likely that, particularly after a recession, where this kind of value cyclicals can get a much better bid than they were getting before. I am concerned about some people's comfort, for example, in software, because they view this kind of SaaS model and things like that, software as a service, things like that. And here's I want to give you kind of this is the picture I want to present, this idea in your head. And when I do it this way, then I'm going to bring it back to software, you'll understand. So let's assume, God forbid, that there's a fire in your boiler room. What you would do is you'd quickly tell everybody to get out of the house, you call 911, and then you might get your fire extinguisher that you have in your house to try to prevent it from spreading until the fire department shows up. I promise you at that moment, you are not thinking about, if you're Norton Security software, is protecting anybody from getting into your email and hacking you. It's just not part of your mental process. So now I'm going to take it to the small and medium-sized business that right now are worrying about their employees, their vendors, their customers, their financing, their facilities, their rent. All these kind of things are the fires going on off in their house right now. They're not interested in somebody talking to them about cybersecurity or let's do an upgrade on your Windows platform. It's just not nowhere near the priority it was 3 months ago. It is way down the list. Call me in 3 months. And I think there's a sense of these are very protected business models, and they're, you know, it kind of just, of course you need software. You do, but when there are fires going, you don't.
Mm-hmm. So there's another question about effects on the retail industry. Obviously, Amazon is like our feeder at the moment for everything. And so what is sort of your outlook on the retail industry? Is there a lot of companies that will disappear out of that, or are they already actually ready to basically face the new world where we do much more online?
So I'm going to be careful. I'm not going to recommend any stocks buying or selling them because I can't. But let me give you a couple of things to think about. So first of all, the online experience clearly has accelerated in this environment because it has to. We had last week a electric toaster oven kind of sizzle itself out. We've owned it for 20 years. It gave us a good run, and we had to replace it. So we went to Amazon by default almost to look up to buy another one, and we were told we will get it April 21st. Well, that's not really helpful.
Yeah.
I went on bestbuy.com and I got it a day later, 2 days later. Okay, so you have other options that are beyond Amazon. Walmart.com is doing really good business. Costco.com is doing really, so there are companies that have learned to have this omni-channel structure. And then there are other businesses that are a lot harder to do that with. So for example, this is just, again, I'm using this to make the point, decided to have a barbecue in our home with my kids and grandkids, and realized I was out of propane. And this is now 5 o'clock on a Sunday, and I run to this little propane station near my house, and they're closed already. And then I said, okay, I'll go to Home Depot. I know they're open. And I drove to Home Depot, a little further away. But we can't disappoint the grandkids. They want their hot dogs. My children want their cowboy steaks. And I was waiting because there are other people ahead of me having their propane tanks filled. And I'm watching people, this is the outdoor section, I'm watching people carrying plants and flowers to go do their gardening. I'm watching people walking out with lumber. I'm watching people one guy walking out with a toilet on his shoulder because clearly his toilet broke and he had to replace it immediately. Not something you're looking for prime delivery in 2 days. And I realized the footprint of a Home Depot may have to shrink, but it's still going to be there because these aren't options that you can get online. Mm-hmm. So I think there are certain parts of the industry that are much, much more protected. And then there are boutiques and unique kind of stores. I can tell you, I'm not a big yoga guy. I'm Canadian, should like Lululemon just for that reason. But I've never been to a Lululemon store in my life, but I know people love going there. So you can have, those kind of, business structures, even in traditional retailing, that will survive. It's the kind of boring department stores that are in a lot of trouble, and the mall REITs that have them as anchor tenants. Yeah.
I have a lot of questions about sort of international diversification, emerging markets in the light of COVID or so. So basically the crisis seems to travel from east to west, and maybe the recovery will also be such that we see some Asian markets rebound before Europe and then maybe the US. So is there sort of a potential to really diversify your portfolio by buying international stocks?
So we have to be a little bit careful. I mean, and I'll give you, EM's a little bit different than just saying international, right? So for example, if I were to look at Procter & Gamble and compare it to Unilever, one company headquartered in Cincinnati, another one in Amsterdam, I know which city I prefer to hang out in, but if you look at their geographic sales footprints, they're exactly the same. So you're getting the geographic sales dispersion irrespective of the headquarter town. And that's what you got to be a little bit, thoughtful about. It's not just EM versus US or Europe. EM also captures not just Asia Pac, but also LATAM and Central and Eastern, Central Europe and Africa. So they start getting to frontier markets, but you're in that emerging world. So I think there's a difference between Asia and LATAM, but one of the biggest problems at EM in general is poor government. Do you really trust the accounting? Those kind of things. So can you get EM via DM? In other words, can you buy US companies that give you EM exposure? To me, has always been a much more interesting trade than trying to figure out stuff. I don't want to spend too much time going on this, but one of my absolute favorite stories, a guy I know who went to see a company in Asia, went to China specifically, went to see a company, thought it was great, bought the company, bought the stock, and of course lost his shirt in the stock. When he went to the country, when he went there, he was picked up by the IR person for the company, driven to a factory, saw all the stuff, thought it was amazing, and that's how he came back. However, the investor relations person who picked him up drove him to a different company's factory, had paid some guy off to walk through it with him. He didn't speak Chinese, didn't know anything about it. The sign was in Chinese, and was totally fooled on the company, right? He literally went to the wrong company, the wrong facilities. So it's part of the problem with some of these places is you don't really know necessarily where you're going. Now, they're better. He was an American. He got totally taken. They're better people, on the ground there who know those things. But still, the governance is not exactly the same. And there have been a lot of accounting issues. The biggest thing you're going to have to care about, though, is the dollar. If the dollar goes up, emerging markets underperform US. If the dollar goes down, emerging markets tend to catch a really good bid on a relative basis. So it becomes a dollar play, and at that point, you may as well just trade currencies.
There's a couple of questions about Europe. So there's some people who think that's basically the end of Europe as we knew it. And what is your view on that? And what does that mean in terms of basically investment strategy?
So I'm a US equity strategist. So my comments in Europe are going to be somewhat less informed than they should. If it makes anybody there feel that I'm more of an internationalist, I'm actually Canadian, but I happen to live here. To my wife's chagrin, I've lived here 35 years, and I refuse to become a U.S. citizen. The issue around Europe is you had monetary unification, and you did not have government unification. And to a certain degree, today what you're seeing is countries acting as politicians should on their own behalf, on their own citizens' behalf, and not worried necessarily. If you're Macron, you're taking care of France. If you're Merkel, you're taking care of Germany. Conte, you're taking care of Italy. And you just can't worry about what people in Portugal or Greece say. They're not the ones who elected you. Orbán in Hungary is now kind of almost autocratically taking over to fight, using the coronavirus to kind of become very, very much independent of the people in Brussels. And it puts inordinate strain. Certainly, there was already problems with people's comfort being told by Europeans what to do, and it's led to things like Brexit. We're getting photobombed here, because I'm seeing somebody out in the streets here. I don't know where, but somewhere. So in that sense, we could have bigger problems in Europe, but I'm probably not the best expert on that. I've worried about Europe for a very long time, but there are a lot of other reasons for it, including population declines. Here's when I'll become a big Europe fan. Okay, when Spanish citizenry cheers the Netherlands teams in the FIFA World Cup, then I'll know they're Europeans.
Yeah, that's probably never going to happen then. So, in terms of sort of the global supply chain and how that may shift, and basically how maybe production will completely change, and then how will that affect the markets? Do you really see that there's a big shift to the global supply chain and world trade coming out of this, or is it just a bump and we get back and then we'll have the same type of economy that you used to have before March?
So I never think when you go through any kind of turbulent experience that you come out exactly the same, right? I will never put this in print because I realize some people would be appropriately offended. But what we're having in a weird way in the markets is a heart attack and in the economy. And what happens is most people survive these things, these cardiac events, but they go on diets and they take pills or they get a pacemaker, they start exercising more. There are changes that take place. The person's still the same person, but there are some changes that take place. I think there's just be another reason to think about supply chains being 4 to 8 weeks away from you on a ship. And maybe US bring production back to Mexico as opposed to Illinois. And German companies bring that production back to Romania, the Czech Republic, or something like that. You still get a lower cost, but not so distant. I think it just gives them more incentive to think about that. And not everything, but some of it, so that they have a buffer against, not a pandemic, but whatever thing happens. They just have another way to make sure that the business risk profile is better positioned for, unforeseen events.
Yeah. Then I also have a couple of questions that are more sort of like personal finance questions and retirement about. So basically looking at my retirement funds, what should I do? Should I basically just sit there and sit it out, or how does this depend on my retirement horizon? What is sort of your general view on how basically you should manage your portfolio through a crisis like this if your purpose is to really save for your retirement?
So it's interesting because I have my son-in-law has asked me this: what should they do with their 401k money? Mm-hmm. Should they pile into the markets or not? I think if you're young and you have long time horizons, yeah. I mean, if your portfolio manager has to make money in the next 3, 6, 12 months, we got to talk. And how we position around that and what are the milestones and markers. But if you have long-term timeframes and you're not looking at this money every day, and it's money you don't need potentially in the next, couple of years. So, if you're sitting there saving for a house right now, I wouldn't suggest you go into something that's risky because you won't be able to get that down payment later. So, I think that kind of notion is interesting. One of the potential, I mentioned houses for a moment. So Warren Buffett, I've heard him say this a number of times, would argue that a home is a lousy investment financially, but a brilliant investment familially. And I think what we're going to see, because of things like social distancing, people are going to say, do I want to be in urban centers? Do I want to be, in an apartment building where I'm afraid to go into the elevator right now, as opposed to be in a house where I can step outside and sit on my porch and get fresh air? So I do think there's going to be a little bit of a change on the whole urbanization argument that was being professed over and over in the last 10, 15 years. Again, if you have those long-term time horizons, different, you really, these are bumps that you're going to have along the way. And I promise you'll have a few more along the way. Maybe not this particular speed, but there'll be bad stuff down the road. We never get through it, but there's only one decade of the last 100 years where you kind of didn't make money in stocks, and that was the 30s. Mm-hmm. Okay. So it's kind of, I wish there was a better vehicle that I could recommend to people over time. Again, your time frame is the key here.
Yeah. Now, basically, times of crisis are also times where certain things are really cheap, and then as active managers, you would like to basically exploit these opportunities. So more generally, what is sort of your view on active versus passive management? It always depends for whom or so, but should there be basically a lot of people who have been passive investors? Should they use situations like crises like this to become active investors, or just, again, they just don't have the skill and they wait until what is happening? And so what is your view in general about active and passive investment? I probably know what you will say, but...
No. So it's a little bit of for those of you who are in, Marcel and I talked about this yesterday briefly in a conversation, so he knows he's picking at this for a reason because he wants me to say something, which is, and I will. Which is, I've never been a huge fan of passive investing because I just don't like settling for mediocrity. Okay, I want to do better than average. I've never aimed for average. And almost think of it in the sense of, I know the Olympics are being bumped a year, but nobody goes in there and say, we're number 5, we're number 5. They want to be number 1. So that's one of my problems with. Now, in certain areas where I don't know anything about, well, let's take EM. In Latin America, I probably would use an ETF because I just don't know the companies. I don't know. I'm going to use the index because it's easier, and I don't know the money managers as well. In the US, I do know lots of the money managers, and I give the money to people I think are smart. They're not necessarily the best returns, but they're asking all the right questions when I talk to them. With respect to the growth of the passive industry has made active managers really have to change their mindset and their approach, which is because 80% of them have underperformed for 3, 5, and 10 years. Not necessarily the same 80% across the spectrum, but fund managers have not, proven their mettle, and they've been paid more than the cheaper cost alternative in an ETF. So what they've changed is their timeframes. They can't sit there and buy investments for the most part with a 12, 18, 24-month time horizon. They may not have a job by then. It might be the right call, but if they're underperforming again in the next 3, 6, 9 months, they may lose their jobs because they're already on pretty good leashes. So I think the time frame for the traditional fund manager, be it a mutual fund manager or a hedge fund manager, has compressed dramatically. And that's one of the reasons I said that my view of what an investor should do over the next month to versus what they should be doing over the next 20, 30 years are wildly different.
Okay, so we are planning for an hour. We're getting close to this hour. There are a lot of people here who are at the moment investing in their human capital, attending the undergraduate program or the MBA program, but all of them want to eventually go out there in the job market. And obviously that's probably a scary moment at the moment to go in the job market. So particular goals also in finance. Can you provide some kind of general advice about how you should look at the situation from a job search perspective?
So it is going to be a tough time, and there's people coming out this year. We do a lot of our recruiting in, at least from the research area, in junior and sophomore years to bring people in for summer jobs to kind of, if you want to call it, see them in a real life world atmosphere and see if they're good or bad and extend them offers. That's where we do a lot of it. When we do on-campus recruiting, I joked around yesterday, and I'll do it with you guys too. For some reason, I've ended up at BC a couple of times doing the recruiting on campus, and I really do enjoy scaring the living daylights out of them, telling them I went to BU, and you're from BC, so impressed me. And it just makes them a little bit uncomfortable, but it's good test. Look, the things that we're going to care about when we talk to people, at least what I care about, is A, are you kind of a decent person? Would I want to spend hours working next to you? And will you work well with the team that I have? That's usually the most important dynamic. The second one would be full curiosity. I'd never want to hear somebody ask me the question of, so tell me the life of Tobias Lefkovich at work. It's like so cookie cutter, so uninteresting. And we know somebody told you in the recruiting office this is what you should do, but you shouldn't. We actually don't care. What we would be impressed is if you looked us up somewhere online, you know a couple things about us, and it just shows that you're prepared. But we want intellectual curiosity. We want you to pick away at that. How do you get a job in a tough environment? So I would say 3 things. One, don't shoot for the moon. The competitiveness of the top firms is going to be are always tough. But in an environment where we're not hiring as many, it's going to be doubly tough. So you don't have to go to the top firms. Go to a secondary firm, a tertiary firm, get a couple of years of experience, and then try to move to another place. Because then the only thing we're going to care about really is your experience and your knowledge base. We're not going to really care what, if you were on the investing club in school or not. Oh yeah, by the way, never put an interest that you don't know anything about, because we will ask you. We're taught how to interview. So if you tell me your reading is one of your favorite things, I'm going to ask you, what's the last book you read? What's your favorite book? Why? If I read it, I will even ask you something about that book, and I read a lot. So yourself in a box very quickly, and then we're going to be impressed by your attempted fraud. The other thing you can look at is something a little bit out of the norm. So try to, if you can't go on straight to a Wall Street firm, that's what you're looking for. Try to work for the state pension board. Try to work for, a insurance company that has an investment, kind of asset management kind of business buried in it. Because there you're going to find probably there's a little bit more on the openings, and you can get in easier and build that work resume that if your passion is investing, you can come back to it. But and you might have to suffer. I talked to a young man who worked at the Federal Reserve Board in Washington. He's from New York. He hated being away from friends and family, but he did it for 3 years and now landed a job at an investment firm about a year ago. But he did it because he was willing to tough it out, and we're going to be impressed with the fact that he was willing to tough it out. And he knew it wasn't his favorite job, but it was what got him to where he wanted to. And okay, the guy was willing to pay a little dues for it. And the one thing I've always said is, we all come out of school and we all think we're really hot stuff, and quite honestly, you're hot stuff amongst a lot of other hot stuff. One of women I trained, who's now one of my competitors and still a good friend, she was brilliant, valedictorian of high school class, went to the University of Virginia program, really, really smart lady. And I always tell her, she would be so upset when she was on Wall Street initially. And I always tell her, like, you're really smart, but you're really smart amongst a lot of really smart people. I squeaked under the line. They didn't figure out I wasn't smart, but it's too late now. They hired me. But for really smart people, recognize there are a lot of competitors who are really smart too.
Yeah. So it's 3:17. We said we'll go until 3:15. I would like to thank you to basically do this for us. I think this is of tremendous value for the students, and also for us, it allows us to basically connect alumni with students, which is something that really want to do. And as I said at the beginning, as an institution, we're really committed to make this a time where we will provide content, and there's more to come. And I also hope we stay connected, and maybe, hopefully not under these circumstances, but can welcome you once on campus. And thank you for this excellent conversation. Thank you for having me. Everybody stay healthy and safe. And I definitely would like to come back on campus. Only one condition, Marcel. There's got to be some good liquor. Good.
Okay.
It's difficult to applaud here, or so we could all clap now somehow, but I saw some yellow things coming up, but yes, please stay safe, everyone, and please stay tuned. Be alert to the announcements that will come about this Questrom Insight series. We have a couple of things planned, and it's a great way to stay connected in a difficult time. Thank you so much.
Take care. Bye-bye.
Take care.